In today's episode, we are looking at Indian banking as a sector. We think this sector is currently in a sweet spot, attractive valuations and sectoral tailwinds, albeit constrained by a few risks. Welcome to Daksham's Deconstruct. I'm Karuna from the research team, where every week we pick one big idea and follow the money behind it. The valuation observation. Nifty Bank is currently trading at price to book of 1.9 times, down from below a peak of 3 times. When you look at where this current valuation sits relative to the last 13 years of history, it is near the bottom of the range. But the picture is not uniform across the sector. Large private banks, HDFC, Kotak, IndusInd, are trading 39 to 42% below their 10-year median valuation. PSU Bank tells a different story. Union Bank, Canara, and PNB are trading well above their historical median, in some cases by over 100%. The derating and re-rating within the sector has not been even. Different pockets are telling different stories, and that dispersion itself is worth understanding. That raised one question. Is cheap justified, or is the market mispricing something? We ran a full SWOT analysis on the sector. Strengths. What is being underweighted? Credit growth in the Indian banking system has reached approximately 18% on year-on-year basis as of May 2026, the highest reading in 2 years. And it is broad-based. Services credit at 19%, MSME at 30%, vehicle finance at 18%, gold loans growing over 120%, retail, MSME, and corporate working capital all growing simultaneously. When the credit expands this broadly, it signals genuine underlying demand, not a bubble in one asset class. Alongside this, asset quality is at a cyclical best. System GNPA at 2.2%, the lowest in 13 years. Corporate borrower balance sheets at their strongest since the pre-2008 investment boom. The system is not lending into a leveraged or a stressed borrower base. Weaknesses, what the market is correctly worried about. The most important concern is the credit deposit gap. Credit growing at 17.65%, deposits at only 12.2%. That gap of 5.5 basis point is the wildest in a decade and has been widening consistently. This may raise the cost of funds and consequently weighs on profitability. Opportunities. What could change the picture? 3 things. Number 1. The RBI launched the FCNR special deposit window in June 26, open through September 26. This is expected to catalyze foreign currency deposits by RBIs with Indian bank accounts. These deposits are exempt from CRR and SLR, meaning 100% of every rupee raised is deployable as credit, versus only 79 paisa from a domestic FD. Industry estimate project inflow of $50 to $70 billion. The FCNR scheme directly addresses the single biggest constraint holding the sector behind, the deposit credit gap. Number 2. NIMS recovery. Old high-cost fixed deposits logged in at 7% or more during the FY26 liquidity crunch are now beginning to mature and roll over at lower prevailing rates. Bank NIMS should stabilize at 3.2% in FY27 and recover to 3.3% in FY28. Every 10 basis point of NIM improvement on a 200 lakh crore loan book is approximately rupees 20,000 crores of additional pre-tax income across the system. NIM recovery flowing into ROA, recovery flowing into earning upgrade is the precise mechanism that drives sector re-rating. Number 3. FII reversal is beginning. FIIs sold approximately 63,000 crores in financials in the first half of 2026. But in the second half of June alone, they bought over 14,000 crores, the biggest fortnightly inflow of 2026. After 3 months of selling, FIIs have turned net buyers in financials. And Strategic Global Capital is separately validating the thesis. Emirates NBD acquiring over 60% of RBL Bank, SMBC approximately 25% of Yes Bank, MUFG approximately 20% of Shriram Finance, Blackstone up to 9.9% of Federal Bank. Long horizon strategic commitments by global banking institutions are arriving at the same conclusions independently. Threats. What could go wrong? One of the risks could be El Nino. A bad monsoon adds food price pressure and some stress in agri and rural credit. Manageable in isolation, but a sustained multi-year cycle would be more serious and is worth watching. The other risk could be oil re-escalation. If the current ceasefire breaks, the improvement in the macro picture for Indian banking is meaningfully tied to crude, coming off from $110 to $70 to $80 range. A return to conflict would reverse that relief quickly. What history says. We pulled up Bank Nifty data going back to 2008, monthly observations across 18 years. Today's 3-year trailing return of approximately 7.8% sits in the bottom zone of the entire history. From this zone, a forward 3-year returns have historically averaged at 15% per annum and were positive 96% of the time. On a 5-year basis, today trailing return of approximately 9% sits similarly in the bottom zone. Forward 5-year returns from here have historically averaged 17% and were positive 100% of the time. History is not a guarantee, but when the fundamentals and the historical pattern point in the same direction, it is worth paying attention. So what's our view? This is not a stock call. The Indian banking sector has the balance sheet of a recovery and the valuation of a crisis. Strengths are structural and quantified. Weaknesses are real but known and partially priced in. Opportunities like FCNR, NIMS recovery, FII reversal are sequenced and in motion. Threats are tail risks that existing provision buffers are designed to absorb. The risk to reward at current valuations is asymmetric. For investors looking at a sector that has been derated without a corresponding deterioration in fundamentals, Indian banking deserves a closer look.